A signature on a loan can feel like a lifeline. For a nation, it can feel like survival. But somewhere between the ink and the interest, obligation turns into dependency, and policy turns into permission. Who controls the terms? Who decides the price? And how does a sovereign state become a debtor that must ask for its future back? You're watching Hidden Finance, where we pull back the curtain on money's most guarded rooms and the power structures that sit behind them. If you're new here, join us as we decode the deals, the institutions, and the incentives that shape economies and lives. Today, we're stepping inside the banking cartel, the interlocking network of central banks, bond syndicates, ratings agencies, and multilateral lenders, and asking a difficult question: how do nations become debt slaves? The answers are older than you think, and the story is not a conspiracy, it's a system. To understand the modern debt machine, we start with a simple truth. Money is not just coins, it's a promise. The ability to borrow against tomorrow is the engine of modern states. In medieval Europe, rulers funded wars through taxes and tributes. Promises were enforced with swords. But as markets rose and empires expanded, the promises became standardized, tradable, and enforceable in court. The legal invention of a bond created a bridge between kings who needed cash and merchants who controlled it. The Dutch and the English pioneered that bridge. In 1694, the Bank of England was founded to fund a government desperate for war finance, trading an interest-bearing loan for the privilege of issuing banknotes. It created something new, a funded national debt, a permanent market of government obligations that could be bought and sold. Government bonds became the safest collateral in the land, the spine of the financial system. With a credible lender and a liquid market, Britain financed wars, built a navy, and ruled a global empire on credit. By the 19th century, the City of London had become the world's capital of sovereign lending. Banking houses like Rothschild and Baring formed syndicates to underwrite loans to railways, empires, and young republics from South America to Russia. These were not random sales. They were carefully coordinated offerings, where a handful of firms set the terms, the prices, and the conditions. When things went wrong, the costs were systemic. In 1890, Baring's overexposure to Argentina nearly detonated the city, and only a rescue organized by the Bank of England and rival houses stopped the collapse. Then an early glimpse of cartel-like coordination to save the system from itself. Across the Atlantic, the U.S. learned a similar lesson the hard way. The Panic of 1907 exposed the fragility of a banking system without a central backstop. And it took the intervention of one man, J.P. Morgan, to gather bankers in his library and force a private bailout. It worked, but it terrified policymakers who saw the dependence on private power. In 1913, the Federal Reserve was created, a public institution to stabilize a national banking system, act as lender of last resort, and manage the currency. Now every major power had its own central nerve center, nodes in a growing network. War amplified everything. World War I shattered the old gold standard and tangled Europe in reparations and debts to the United States. In 1930, the Bank for International Settlements, the BIS, was created in Basel to administer German reparations and facilitate cooperation among central banks. Officially, it was a place to clear payments and share information. Unofficially, it became the quiet club where the world's monetary authorities learned to coordinate. But coordination couldn't stop the Great Depression, and competitive devaluations and defaults showed the cruel power of capital flight over sovereign plans. The answer was Bretton Woods, a new financial architecture built in 1944 by war-weary allies. They created the International Monetary Fund to police exchange rates and provide emergency financing, and the World Bank to fund reconstruction and development. The US dollar was pegged to gold, other currencies were pegged to the dollar. Capital controls were accepted, growth was prioritized, and the world recovered, under rules designed in conference rooms, not trading floors. For a time, this arrangement contained crises and channeled credit into rebuilding an industry. But money finds the seams. In the 1950s and 1960s, dollars migrated offshore into the euro-dollar market. U.S. currency held in foreign banks beyond direct American regulation. This shadow ocean of dollars lubricated global trade and finance, growing into trillions. Then came 1971. Nixon closed the gold window, the dollar floated, and money was unmoored from metal. Oil prices spiked, petrodollars surged into Western banks, and those banks recycled the cash into loans across the developing world. The system's pipes expanded, so did the pressure. In 1979, Paul Volcker became chairman of the Federal Reserve and waged war on inflation. Interest rates in the United States surged to nearly 20%, and dollar-denominated debt around the world suddenly became unbearable. In 1982, Mexico signaled it could not pay, triggering a cascade across Latin America. The IMF stepped in with rescue packages, but they came with conditionality, austerity, privatization, trade liberalization, and fiscal discipline. For many, the 1980s became a lost decade of low growth, rising poverty, and a bitter lesson in what happens when your loans are in someone else's currency. The 1990s brought restructuring. The Brady Plan converted defaulted bank loans into tradable bonds, giving creditors liquidity and debtors longer maturities. The Washington Consensus, a set of policy prescriptions favoring deregulation, open capital markets, and privatization, became orthodoxy in many capitals. Then, in 1997, a sudden stop hit Asia. Thailand's peg broke, contagion spread to Indonesia and Korea, and IMF programs again paired financing with tough reforms. Critics accused the fund of one-size-fits-all medicine, too much austerity, too fast liberalization. Defenders argued there were no painless cures for panic. So where is the cartel? It's not a smoke-filled room with a villain's master plan. It's a network with rules, gatekeepers, and priorities that tend to protect the system first and the borrower second. Central banks coordinate through the BIS. Ratings agencies can downgrade a sovereign with a paragraph. Bond contracts under English or New York law constrain how debts can be restructured. Primary dealers underwrite government auctions, while legal provisions like pari passu and collective action clauses dictate who gets paid when things go bad. No single hand controls it, but the hands know each other well. And how do nations become debt slaves? It begins with original sin. Many emerging countries cannot borrow internationally in their own currency, so they issue debt in dollars or euros. That creates a mismatch. Revenues in local money, obligations in a foreign one. So every devaluation makes the burden heavier. Short maturities mean constant rollovers, and when a crisis hits, lenders run, currencies fall, and interest costs explode. To get relief, governments agree to conditions that reshape their economies and politics. Sovereignty narrows to a spreadsheet of targets. The budget becomes less a plan than a promise to creditors. Look at Greece after 2010. Years of hidden deficits and easy credit collided with the global financial crisis, and bond markets shut. A troika of the European Commission, the European Central Bank, and the IMF organized bailouts, but in exchange for deep austerity, tax hikes, and reforms. The social cost was immense. Unemployment soared, pensions were cut, public assets were sold, and an entire generation felt exiled from opportunity. In 2012, private creditors took haircuts. In 2015, the ECB's power over Greek banks forced a referendum's reversal. The message was clear. Membership in a monetary union without full fiscal union binds you tightly. To rules, to markets, and to institutions that decide if your banks open next Monday. Consider Argentina. After defaulting in 2001, it faced holdout creditors who bought distressed bonds and refused restructuring deals, litigating in New York courts and winning extraordinary enforcement. For years, a small group of hedge funds could block Argentina from paying other bondholders, illustrating how contract law can trump political will. In 2018, facing inflation and capital flight, Argentina agreed to the largest IMF program in history, only to see crisis return and the peso collapse again. Debt relief brought temporary breathing room, but the cycle of devaluation, austerity, and inflation persists, narrowing choices for ordinary families and policymakers alike. Now consider the new map of lending. China's Belt and Road Initiative poured money into ports, power plants, and roads across Asia, Africa, and beyond, often at commercial rates and with confidentiality clauses. Some argue this is debt trap diplomacy, but the reality is more complicated. In places like Sri Lanka and Zambia, the causes of distress include domestic mismanagement, global commodity swings, and market borrowings as much as Chinese loans. Yet restructuring is harder in a world of many creditors. Private funds, multilaterals, bilaterals, who don't always agree. The G20's common framework aims to coordinate relief, but progress is slow. Every delay means schools and hospitals wait while lawyers negotiate. Crisis also tests who gets a lifeline. In 2008 and again in 2020, the Federal Reserve extended dollar swap lines to a select group of central banks, guaranteeing them access to the world's reserve currency. Those inside the ring got stability. Those outside turned to the IMF or burned scarce reserves. Advanced economies launched quantitative easing, buying their own government debt at massive scale, holding down yields and lifting asset prices. The safety net is real, but it has membership tiers, and membership shapes destiny. The consequences are not abstract. When debt service overwhelms budgets, governments cut investment in education and health. When currencies collapse, food and fuel become unaffordable. Political systems strain as voters reject elites they see as beholden to outside powers. Inequality widens when asset owners benefit from central bank support, while wage earners face austerity. And a generation learns a lesson that's hard to unlearn. The global economy is open, but the doors are different for different passports. Yet credit is not the villain. Debt-financed roads, vaccines, and electrification. It helped cities rise and industries scale. The problem is the structure. Short-term loans for long-term needs, foreign currency debts for domestic projects, private gains with public losses, and contracts that leave little room for democratic choice when things go wrong. The cartel's power is not in secrecy alone. It's in the quiet inertia of norms and the fear of panic. Systems built to prevent catastrophe often trade away agency in the name of stability. There are alternatives. Debt contracts can include contingency, payments that fall when disasters strike, instruments linked to GDP or commodity prices that share risk. Collective action clauses, now common, can limit holdout power in restructurings. Better still, open data on debt terms can prevent dangerous surprises. Development in local currency bond markets can reduce reliance on foreign money. Measured capital flow management can temper booms before they become busts. SDR allocations, like the $650 billion issued in 2021, can provide global liquidity without conditions if rich countries reallocate them to those most in need. For low-income countries, the Heavily Indebted Poor Countries Initiative and the Multilateral Debt Relief Initiative showed that genuine relief is possible and powerful when the political will exists. Today, the test is to update that spirit for a multipolar creditor world where China, private funds, and traditional institutions all share the table. Climate finance adds urgency. Countries on the front lines need capital that doesn't become a noose. The choice is not between discipline and despair. It's between smarter rules and the repetition of old mistakes. For advanced economies, illusions are also dangerous. The United States enjoys exorbitant privilege, issuing debt in its own currency at scale. Europe's monetary union is a masterpiece with missing pieces. Japan's long dance with debt and deflation shows how far a central bank can go. But interest costs are rising, political polarization is deepening, and demographics are unforgiving. Even in the core, debt shapes policy and the bargaining power of future generations. The phrase banking cartel suggests a villain in a shadowed room. The real drama is more systemic, more legal, and more human. It's how emergency becomes routine, how necessity becomes doctrine, and how a ledger can dictate life for people who never signed it. The cartel thrives not just on secrecy, but on our acceptance that there is no other way. History says there's always another way, if we are willing to change the terms. Remember the mechanics. Who sets the currency, sets the rhythm. Who writes the contracts, writes the options. And who controls the backstop, controls the panic. A sovereign without monetary sovereignty is sovereign in name only. Building resilience means borrowing better, sharing risks, and designing institutions that keep power accountable to people. In the system, transparency is not a virtue, it's armor. What does it mean to break the cycle? Not to reject debt, but to insist on fairness, on loans that match maturities to reality, on clauses that recognize shocks, on restructurings that come quickly with burden sharing, and on a safety net that includes more than a privileged few. It means democratic debate over the costs we hide in footnotes and appendices. It means remembering that the bond market is not the only audience a government must answer to. And it means naming the system for what it is so we can reshape it for what we need. Because in the end, the most expensive thing a nation can borrow is time, spent waiting for permission to govern itself. This has been Hidden Finance. If this opened your eyes, subscribe and follow for more deep dives into the power behind the numbers, and share this story so others can see the systems that shape their lives.